people who know the playbook, not just the wealthiest, but the most well-informed, buying gold at levels the world's never seen. And now you're seeing all the exchanges being bled dry, a continuation of what we've been talking about for 3 years. What does that mean? That means they're selling treasuries, not rolling them over and reinvesting them, but instead buying gold. And look at this, look at how that's played out for the last 24 years. If you go back to 2000, gold has appreciated by 7.8% per year. The S&P, 7%. And the bond market, less than half of that. So you have no default risk, no counterparty risk. It's an asset that is not simultaneously someone else's liability. You have much less in the way of interest and inflation risk.
The North African nation of Egypt has announced its intention to negotiate using national currencies for trade with other BRICS partners, signaling a potential shift away from the US dollar. AndySchectman, CEO of Miles Franklin, highlights that several BRICS countries, including China, India, Egypt, Saudi Arabia, and Iran, have already been conducting trade using local currencies, indicating a gradual reduction in their dependence on the US dollar. The impetus for this move precedes the establishment of a unified settlement currency among BRICS nations. Dilma Rousseff, former president of Brazil and current chair of the New Development Bank, has echoed the sentiment of avoiding reliance on a single currency. The Brazilian finance minister has also proposed a South American international currency, starting with Brazil and Argentina. Additionally, the European Union has expressed a desire to reduce dollar dominance, with the German foreign minister advocating for a new EU-based payment system independent of the US and SWIFT. Schectman emphasizes that a collective shift towards local currencies and a preference for gold over US treasuries could significantly diminish the dollar's supremacy in international trade and finance. China, a key player in this potential transition, has gradually declined its holdings of US treasuries since peaking in 2012 to 2013. Its gold reserves have also been growing, hinting an interest in diversifying its financial assets. Schectman predicts that the shift from the dollar might happen swiftly, leading to a notable transformation in the global financial landscape. Join us as we explore the insights shared by AndySchectman. Stay updated by subscribing to our channel and activating notifications. Thank you.
We've been talking about the Bridge for about a year now, which is a way for these countries to, and I'm glad you brought this up because to me, this is a very important point. You know, the Bridge is a bridge that allows these digital currencies, these nations' currencies to trade with one another, sidestepping the SWIFT system, which is the way that the United States imposes, one of the ways they impose sanctions. And, you know, maybe I'm guilty as well of focusing too much on the Russian finance minister's proclamation that, hey, we're going to have a unified settlement currency that will be pegged to a basket of commodities. And maybe that will happen, right? But look at what's been happening, right? If you look at China as an example, at one point they had almost $3 trillion worth of our treasuries. They're down to 700 or 800 billion. It's still a lot, but they are shedding treasuries at a rapid rate, the lowest level they've had in 16, 17, 18 years. And the same thing is true of many of these BRICS nations that are no longer bidding for our treasuries. So when you think about it, you know, we were told at the end of the August meeting that they would all go back, the finance ministers, to the drawing board, come back and present their findings for a common settlement currency. But in the meantime, everyone trade in their local currencies. And that is indeed what we are seeing, and more proclamations all throughout the BRICS nations, whether it be India, whether it be Egypt, Saudi Arabia, Iran, Russia, they're all trading with one another using local currencies. And the difference, the delineation here, when we talk about that particular move, right, trading outside the dollar in local currencies, well, you know, we saw 20% of oil sales settle in other currencies this year. That's a big divergence. But as we continue to see this BRICS conglomerate grow, and there's another 35 countries that have formally applied and 20 that have expressed interest, and this mass adoption grows, and all of these countries agree to trade in local currencies. Remember, the petrodollar is not just the dollar being what oil is sold for. That's part of it. The other part was taking the excess and the reserves and putting it into US treasuries. So number one, you start to chip away at the settlement status of the dollar, which is big deal, especially as we see more and more and more of these oil producing countries be part of the BRICS group and all of these countries that produce the world's commodities as part of this group that always settled in dollars will now settle in local currencies. And instead of taking that excess, the excess currency that they would otherwise have just sitting there earning nothing, they would typically put it into US treasuries, which are very liquid and very safe. Well, instead, what you're seeing is 2+ years, almost 3 years in a row of the central banks, the people who know the playbook, not just the wealthiest, but the most well-informed, buying gold at levels the world's never seen. And now you're seeing all the exchanges being bled dry, a continuation of what we've been talking about for 3 years. What does that mean? That means they're selling treasuries, not rolling them over and reinvesting them, but instead buying gold. Look at how that's played out for the last 24 years. If you go back to 2000, gold has appreciated by 7.8% per year. The S&P, 7%. And the bond market, less than half of that. So you have no default risk, no counterparty risk. It's an asset that is not simultaneously someone else's liability. You have much less in the way of interest and inflation risk as it pertains to using gold instead of US treasuries as the replacement for the reserve. So if they settle in other currencies and put the excess into gold, as it very much appears like they are doing, you will begin to rapidly, and I mean rapidly, chip away at the dollar hegemony.
A new Bank of America survey suggests that fund managers are increasingly concerned about potential trouble in the commercial real estate sector to trigger a credit crisis in the United States. Andy, an expert in the field, anticipates that such a crisis could arise if the Federal Reserve were to halt its funding program. This program has been instrumental in providing a liquidity source for banks, enabling them to sell treasuries at a profit and borrow at lower rates. Andy further notes that an election year might influence the timing of any potential action by the Federal Reserve, as a significant banking crisis could have political repercussions. The Federal Reserve's policies have historically been entangled with presidential election campaigns. For instance, during incumbent President Jimmy Carter's 1980 re-election bid, the Fed faced mounting inflation concerns, with the annual rate peaking at 14%. In response, Fed Chair Paul Volcker significantly increased the Fed's key interest rate by 10 percentage points in the latter half of 1980. This move, aimed at curbing economic growth and moderating inflation, was criticized by President Carter, who partly attributed his electoral loss to the Fed's actions. Let's get back to the interview.
Suspect that they'll probably find some other way of injecting money into the system. But, indeed, if they are true to the word and they cut it on March 11th, which will coincide very closely with the reverse repo market being drained, one has to wonder what that is going to do to the system, this crisis, if you will, of credit, this slush fund that has been available not only to the banks to reliquify them, selling their treasuries that were valued at 50, 60 cents on the dollar, selling it at par or 100% face value. That money has to be paid back. And that money has to be paid back supposedly starting March 11th. Now, the loans are being made up until March 11th, which in theory means that you have a lag, if you will. If they're still getting loans up to March 11th, that would mean that 1 year from March 11th is when all hell would break loose, because not all of the loans were made at the very beginning. In fact, many of the loans were made during this last few months where they were able to borrow at 4.7% and then give it back to the Fed in a different window and get paid 5.3%, just the complete and total lunacy. But yeah, if they're true to their word, which I guess at this point, it's very hard to believe anything that they say. And we've been saying this all along, that, rates aren't going to go down, and at least not in the foreseeable future. They will lose all credibility if they do that. And inflation is here to stay. And, just go out to dinner once and tell me that inflation is not really here. And it is here, and it's not going away. And it's, as far as I'm concerned, I mean, just look at the basics. How the heck do you pay for Medicare and Medicaid and Social Security and government military pensions on top of the $34 trillion debt obligation? How do you pay for all these liabilities to the American public when the rest of the world are selling treasuries? Who's going to buy our bonds? Who's going to finance the ridiculous debt binge that the federal government is on? They're addicted to debt. Who's going to finance it? And let alone the nearly $10 trillion in 2-year treasuries. I think 8 trillion in 2-year treasuries that need to either be rolled over at higher rates now or paid off. Who's going to do that? And how does that happen? And so I think inflation is here to stay and will only get worse. And so when you put it all together, we are running into some very dangerous times. If indeed they do stop the funding program, you're looking at a banking crisis. And it would be hard to believe that they'll let that happen in an election year where you'll start to see a run on the banks. But, indeed, I would say the likelihood of this happening closer to 2025 in March, because, there are still banks that are taking advantage of this until March 11th, and those loans are good for 1 year. So don't expect something crazy to happen March 11th. I would say as we get into the following year, spring, the likelihood of some really big fireworks, I think, are fairly likely.
Would you agree that a credit crisis arising from the commercial real estate sector could influence Federal Reserve policy and, subsequently, the U.S. presidential election? Please share your views on these topics and consider subscribing to our channel to stay informed. Your input is valuable to our community, and we appreciate your participation.